Hi, David here from Critical Trading. In today's video, I'm going to share a super simple mechanical trading edge that has been coded in 6 lines of code and produces this bright equity curve on this screen that's been consistently beating the benchmark, which is shown in the darker color. On top of this, this edge isn't actually based on any indicators whatsoever, but on something that's quite often overlooked, a seasonality edge that can be very powerful when used right. What exactly is it and how to use it? Well, watch this video to find out. If you've just come across my channel, my name is David and I make high quality trading videos in which I share systematic trading edges and valuable know-how that truly helps you in your own trading. If that's something you're looking for, then do me a favor and subscribe. When you do so, ensure that you enable the notifications as well. You do that by clicking the bell icon. Now, this needs to be done in order for you to actually receive a notification when I publish a new video. Much appreciated. Right, let's get right into it by looking at the code I just mentioned. The seasonality edge that I will share with you today is based on 2 markets. First, the S&P, which I will backtest on the SPY ETF, so the exchange traded fund that tracks the US stock market. The logic is very simple. Buy on the last trading day of the month, provided that the stock market is above its long-term moving average, so 200-day moving average to be precise. The first condition is written here, and the second condition I just mentioned is on this particular line. This code comes from the analytical and backtesting software that I use for my own systematic trading. The software is called AmiBroker, and I can highly recommend it to anyone who's serious about systematic or algo trading. Now, I am not affiliated with this company by any means, and so my recommendation here truly comes down to my own experience. It's really powerful and flexible, and once you grasp its programming language, you can do so much in it, far more than any other more mass market software out there. I will be launching a brand new systematic trading program in a few weeks, which will be heavily focused on coding systematic strategies in AmiBroker. To be precise, the program will include 5 systematic trading strategies that we will code from scratch, among other things such as free data, strategy scanners, and hands-on support and a community. If that sounds interesting, then stay tuned. I will be releasing all details of this program in the coming weeks, and the program will be launching around mid-May. Now, back to the seasonality edge in the stock market. The edge lies in buying the S&P on the last trading day of the month. The end of month in the stock market has historically been proven to offer higher rates of return than other periods of the month. This market anomaly is commonly referred to as the end of the month effect. So we're buying the SPY on the last trading day of the month, but also we want to see that it's above its 200-day moving average. I've put this additional rule in to ensure that we do not buy during periods of prolonged bear markets. The second seasonality edge lies in treasuries. The 20-year treasuries to be precise, which I'll backtest on TLT ETF. The edge here is similar but more frequent. We buy the TLT every Thursday at close. This condition is written on this line here. On top of this, the closing price has to be below the 5-day moving average, which is the second condition written on this line. So those were the 6 lines of code that cover simple seasonality trading edges in the treasuries and the stock market. Then I simply set my buy variable in AmiBroker, depending whether the symbol is the SPY or TLT. In both cases, the exit is when the ETF closes above the previous day's high. That's it. Let's backtest this. Now, if I hit backtest now, I should get all my trades, and you can see how fast AmiBroker is. Literally a couple of seconds to backtest around 14 years of data and generate all these trades visible on this list. The equity curve of these 2 simple seasonality edges is, as I've shown you right in the beginning of this video, it shows a surprisingly high stability, especially when compared to the benchmark. The buy and hold of the SPY acts as a benchmark here and is plotted in the darker line. We can see that this elementary trading logic with its core buy and sell rules coded over 6 lines of code managed to produce far smoother returns, and this is visible during the global financial crisis of 2008 in this area. Let's have a look at both TLT and SPY example trades. Let's look at the most recent trade in TLT first, so the treasuries. This simple seasonality trading logic bought the TLT on this day, the one I just highlighted with the vertical marker, on 18th of March 2021 to be precise. The position was sold on the following day, 19th of March 2021. Let me just zoom out a little bit to put this trade into the wider context. We can see that this particular trading logic managed to pick a major price bottom, although obviously this is not the right way of looking at your trades. The market could have just carried on going lower. And let's also look at the seasonality trade in the stock market, which would have been made in the SPY, so the highlighted line, for instance. Again, trade is marked by small arrows on the screen. The entry was made on this day, which is 29th of January 2021, which is in line with what I coded, as it's the last trading day of that particular month. The trade was closed on this day, the one I've just highlighted with vertical marker. This is again in line with what I'm expecting. This day closed above the previous day's high, and so a valid exit signal gets generated. But now, since both of these seasonality trading setups are not very frequent and are not invested in the market for prolonged periods of time, what if we combine them with some other low exposure setups? If you're my subscriber and watch my videos, you may remember that I've recently published a video about one candlestick pattern that I backtested as well. So what if we combine both of these seasonality setups and two candlestick patterns from my previous video? The candlestick patterns I'm referring to are called engulfing patterns. I've got the list of trades prepared on the screen. These are backtest results of both bearish and bullish engulfing patterns, as I've described them in detail in my previous video, traded on 3 different US stock ETFs. Let's have a look at an example trade, but this time let's have a look at a losing trade, so I don't just show you profitable trades only. The engulfing pattern got generated on this highlighted day in SPY, and so a long entry was made on that day, where the trade was closed on this highlighted day. So let's now combine both seasonality setups and two simple candlesticks traded on daily time frames and see what the results are. I've got my portfolio analysis spreadsheet shown on the screen. I've built it using VBA, which is an older programming language that you can use to automate some repetitive tasks in Excel. In this particular case, I've used VBA to batch import different CSV files with equity curves of different trading strategies and then calculate a wide array of different performance metrics, such as maximum drawdown percentages, their lengths, Sharpe ratio, and so on. I've run this simulation with 20,000 starting equity, where the capital is split equally among the two systems. So 50% is allocated to the simple seasonality trading logic I've explained in this video, and the other 50% is allocated to trading candlesticks on 3 different ETFs. As far as the performance is concerned, compounded annual return of 11% with an associated maximum drawdown to generate this return of 15.2%. Now, this is not supposed to be a final fully fledged trading strategy by any means. I'm merely testing a combination of 2 trading edges. Due to this, the longest drawdown period is at 600 days, which in order for this to be made into a trading strategy would definitely need to be worked on. However, in terms of other metrics, this elementary combination of trading setups is already beating the benchmark. We've got considerably lower annualized volatility, 10% compared to 20%. Annualized volatility of returns essentially gives you an idea about the volatility of your equity curve. In general, I'm looking for a figure of around 10%, as I'm generally quite conservative trader. The maximum drawdown is at 15.2% compared to over 56% of the benchmark, which obviously is a huge difference. At the same time, the average return is higher than that of benchmark, and this is after the trading commissions have been accounted for. Let's have a look at the profit distribution as well. When I'm analyzing my swing trading systems, I'm generally looking at the monthly equity curve or monthly profit distribution. This is due to the fact that swing systems, so systems that are based on daily time frames, need to be looked at from a sufficient perspective. We can see that this simple combination of two low exposure trading setups generated over 31% in 2020. Now, because both of these setups are low exposure, meaning they're invested in the market very rarely and are mostly in cash, they could potentially share the capital as well. This would obviously mean that the capital would be used more efficiently and would likely result in higher percentage returns. There's quite a few options on a portfolio level where you start focusing on the performance of strategies combined rather than performance of individual strategies. And finally, this is a plot of daily equity curves. Orange is the seasonality edge trading on the SPY and TLT. Blue is the engulfing candlestick pattern traded on 3 different US stock ETFs. The turquoise line is both of these combined and traded in a small portfolio. And again, since both of these edges are very low exposure, meaning they're not invested in market most of the time, one could potentially add more trading setups into a portfolio and have them sharing their capital to improve the performance. Hope that you enjoyed today's video and got some inspiration out of it for your own trading. This is David at Critical Trading, signing out.